In this lesson, we're going to learn what is the exchange rate, what a base currency is, and what is a counter currency. What is the buying price and selling price, the difference between those currencies? What is a pip and how it's calculated? Why are commissions in the Forex market lower than commissions in the stock market? What are the acceptable spreads in the Forex market? What is position and what is leverage? Currency pairs and buying and selling rates. In foreign currency trading, there are always currency pairs, the base currency and the counter currency. Now, the base currency, it is in essence our product. It is denoted on the left side of the pair. We always buy or sell the base currency. The counter currency, well, that's the means of payment and is denoted on the right side of the pair. In a transaction involving the euro-US dollar, I buy or sell the euro against the US dollar, wherein the means of my payment is the US dollar. The exchange rate is the price of 1 unit of the base currency in terms of the counter currency. Let's take a look at the euro against the dollar. 1 euro is equal to $1.5220. The spread. A spread is the difference between the buying price and the selling price and is the commission which you pay as a currency trader. For example, if, for instance, you want to convert dollars to euros at the bank, they're going to tell you that the buying price is 1.56 and the selling price is 1.49. In other words, in order to buy 1 euro, you have to pay a little more than $1.50 US dollars. If, in that very moment, you want to sell your euro to the bank will buy 1 euro at a price slightly lower than 1/2 of a US dollar. So, if you sold 1,000 US dollars to the bank, you'll receive 641 euros. By selling the euros back to the bank, you're only going to get 955 US dollars. Now, you paid 1,000 US dollars and received 955 US dollars. So, where are the other $45? This is the profit of the change store. This is the commission they charge from their customers. This is the only commission that you will pay. In the Forex market, there are no additional commissions. A pip. Another important concept in the Forex market is the pip. Pip, singular, or pips, plural. In the Forex market, the exchange rate rises by pips and falls by pips. For most of the currencies, the pips are denoted 4 places after the decimal point. In other words, if the euro-dollar rate is 1.5220, then the number of the pip is 0. If the exchange rate was previously 1.5220 and now it rose by 1 pip, the exchange rate will be 1.5221. If the exchange rate fell by 10 pips, it would be 1.5210, and so on. The Japanese yen is different. For the Japanese yen, the pip is denoted at 2 places after the decimal point, meaning that if the US dollar Japanese yen is 88.57, then the pip is equal to 7. If the exchange rate rises by 3 pips, it will be equal to 88.60. And if it decreases by 27 pips, the exchange rate would be 88.30. Average daily fluctuation. To become acquainted with the concept, the average daily fluctuation of the euro-dollar is about 100 pips a day. On more turbulent days, the fluctuation reaches 200 to 300 pips. On calmer days, the fluctuation reaches 50 to 60 pips. And in terms of percentage, if the exchange rate is currently 1.5220 and I want to announce tomorrow that it rose by 1%, it would be represented by a rise of 152 pips. So, if we said that the daily fluctuation of the euro to dollar is about 100 pips a day, by what percent does the euro-dollar fluctuate on average? About 0.7 to 0.8%, and in more turbulent periods, 2% at most. From this, we can learn of a new and important advantage that exists in the Forex market. This market is stable, and I'm referring mainly to the major currencies, the euro, the US dollar, the pound, the yen, and the Swiss franc. This is a stable market, with exchange rate fluctuations of 0.5% up to 1.5% throughout the day. There's no possibility that you will trade a currency and lose 10 to 15% in one single day. Value of pips. Let's now learn what is the value of every pip within the confines of a particular transaction. If the exchange rate of the euro to dollar is 1.5220 and you want to buy 100,000 euros, how many US dollars do you have to pay? 152,200 US dollars, of course. A second passes and the exchange rate rises to 1.5221. By how many pips did the exchange rate rise? By 1 pip. And what is the current value of 100,000 euros? 152,210 US dollars, which is $10 more. The value of 1 pip in a transaction of 10,000 euros is 1 US dollar. In other words, in a transaction of 100,000 euros, each pip has a value of 10 US dollars. And in a transaction of 1 million euros, 100 US dollars. How are pips calculated? We take the amount of the transaction that we have performed in terms of the base currency and divide by 10,000. This is the value of 1 pip in terms of the counter currency. For example, for a transaction of 100,000 euros, we divide by 10,000 and we get 10. This means that the value of every pip is $10. If we execute a transaction of 30,000 euros, every pip is worth 3 US dollars. For the Japanese yen, the calculation is slightly different. We divide the amount of the transaction in terms of the base currency by 100, and that is the value of the pip. For example, a transaction of $100,000 in the currency pair dollars to yen, we divide by 100, and the result is 1,000 yen. Assuming that the exchange rate is 88.00, we divide the 1,000 by 88, meaning 11.36 US dollars per pip. Here's another example. We'll take the currency pair of euros to pounds and a transaction of 100,000 euros. Each pip is worth 100,000 divided by 10,000 and therefore worth 10 US dollars. And in what currency are we paying in? In pounds, meaning that every pip is equal to 10 pounds. Size of the spread. Do you know what the accepted ask-bid spread is for the euro to dollar exchange rate? 3 pips. So in order to perform a transaction of 100,000 euros, which is equal to $152,000, how much commission must we pay? Well, if every pip is equal to $10 in a transaction of 100,000 euros, and the spread is 3 pips, we're going to pay $30 in commission, which includes the purchase and the sale. Commissions. If we compare the commissions rate paid in the stock market, we'll notice that in the Forex market, the commissions rate is very low. For example, in a 10,000 euro trade, the stock's commission is 0.5%, hence 50 euro. In the Forex market, however, you'll pay only $3 commission for a 10,000 euro trade. For a 100,000 euro trade, you're going to pay only $30 commission, and so on and so forth. Trading rules. If you trade a certain product and you think that its price will rise, you're going to buy it, and if its price indeed rises, you're going to profit when you sell it. And if you're wrong and its price goes down, well, you're going to lose. For example, if you trade wood and you think that the wood price will rise, you buy 10 tons of wood when the wood price is $100 per ton, and later you sell it when the price rises to $150 per ton. You've profited $500. If you thought that the wood price would decrease, you'd wait until the price reached $50 per ton, and then you would have bought the same 10 tons at only $500. The rules are, a trader who thinks the value of his product is going to rise buys more goods and waits for the price to rise in order to sell. A trader who thinks the value of a product is going to fall rushes to sell the goods and makes the most of his money. Traders do not always have to lose everything or gain everything. The trade can be stopped in the middle, and such a situation will be expanded on further. Now let's look at this in terms of the Forex market. If you expect the exchange rate of a currency to rise, you're going to buy it. If you expect the exchange rate of a currency to drop, you're going to sell it. The sum which you profit or lose depends on the volume of the transaction which you perform. The greater the transaction is, the more you can profit, but you're going to take on a greater risk, And the smaller the transaction is, the smaller the profit will be, but you'll have taken on a smaller risk. Trading currencies is exactly like buying and selling wood, tomatoes, or cucumbers for that matter. We buy the goods when we think the price will rise, and we sell the goods when we think the price will fall. Transaction position. In order to complete a transaction, we need to perform a purchase and a sale. If a purchase and a sale were not performed, then the transaction was not completed, and it doesn't matter if you're going to gain or lose in the course of the transaction. Now remember, this is an important rule. Realization of the gain or loss occurs only when the transaction is complete. Position is in essence a transaction. The opening of the position is the opening of a transaction for a currency pair. The open position is a position which hasn't yet been closed. In other words, the transaction has not yet been completed. And a closed position? Well, that's a transaction which has been completed and the actions of purchase and sale have been performed. Leverage. What changes the whole picture and turns the Forex market into a market of opportunities to profit a lot of money in a short span of time? That's leverage. But of course, leverage causes trading to become more risky. So, what is leverage? Well, brokers allow you to perform transactions in sums of money which are much larger than the amounts that you have in your account. Sometimes even up to 400 times more than you have invested. Let's look at an example. You've deposited $1,000. The exchange rate of the euro against the dollar is 1.5220. And you believe that the price of the euro is about to rise by 100 pips. That's your opinion. You can pick up the phone and call the broker or give an order via the computer 24 hours a day. Please buy me 100,000 euros. Now, despite the fact that you've only deposited $1,000 and 100,000 euros costs $152,000, in this case, you've taken advantage of a leverage of 152 times the money which you have in your account. In a transaction of 100,000 euros, how much is each pip worth? Well, we learned that already. Remember? $10. Let's assume that the exchange rate indeed rose to 1.5320. How many pips have you earned? 100. And how much money have you earned? 100 times 10 equals $1,000. Let's deduct the commission and the net profit from the transaction. Now you've got $970. Nearly 100% return in one day. How great is that? But what will happen if the exchange rate falls to 1.5120? Well, you've lost 100 pips and you've lost all of your $1,000 investment. Should you leverage? Later on, you will learn whether it's worthwhile to leverage your transactions and by how much. But one must always remember, for whoever wants to leverage, the option is always available, but it's risky. When there is a leverage of 300 times, you can perform a transaction of 300,000 euros as well. And if the price rose by 100 pips, you can even earn a 300% return in one day. But if the exchange rate decreases by 33 pips, you've lost your whole investment. Why do the firms allow us to leverage? Well, the answer is quite simple, really. It's preferable for them that we perform a transaction of 1 million euros rather than a transaction of 100,000 euros. In this way, the broker earns a commission of $300 and not $3. Later on, you will learn what your interest is as traders and why you shouldn't be tempted to leverage transactions.